Anyway, going along through here, there's some cases that I want to talk about. The first one I'm going to talk about is a fellow named Singleton. And Singleton was an interesting man because Singleton was a lawyer, and he borrowed, or he had $300,000 in his legal trust account to look after the expenses and be a guarantee for the partnership he was in a law firm. At the same time, he was buying a house for approximately $300,000. So he got his partners to agree he could take the $300,000 out of the law firm, because if he took the $300,000 out of the law firm, they wanted some money. He could pay cash for his house. It was his money. It was tax-paid money. So they gave him his $300,000 back, and John Singleton went and paid cash for his house. But the law firm guy said, but John, you got to have $300,000 in this account as your share of the float, the money used to cover the law firm's expenses and cover its line of credit and other things that it might do. So when they did that, he paid cash for the house, and then he borrowed the money back really quickly and put it back into the trust account for the law firm. Well, that was cool, because he then said, well, I borrowed this money for investment purposes, and when he borrowed it for investment purposes, he ended up in a situation that he had the, what's the right word, he had deductible interest. And he deducted on his tax return for a couple of years, and the tax office came back and said, you can't do that, John Singleton. And he said, well, yes, I can. So he appealed it to the Tax Court of Canada, and the judge of the Tax Court of Canada said, no, you can't, John Singleton. But it's easy to appeal the Tax Court of Canada decision, so he appealed it to the Federal Court of Appeal. He skipped the federal court. He just went straight to the Federal Court of Appeal. And when he went to the Federal Court of Appeal, 2 judges said he couldn't do it, and 1 judge said he could. Since a judge had said that he could, and there was a split decision, as it were, he had the legal right to apply and take it to the Supreme Court of Canada. And to their credit, the Supreme Court of Canada, which rejects, I don't know, 16 out of 17 cases that are brought to it, doesn't even look at them. The Supreme Court of Canada said, yes, we'll look at it. And when they looked at it, the Supreme Court of Canada came back and said, yep, John, you can deduct it. So the rule came back that you could borrow money, do what was called expense damning, as I explained before. And for the first time ever, we had a Supreme Court case that said, yes, you can do it. Now, I'd been doing this for a couple of thousand people up until now. So John Singleton did it. He won his case, and that was a good case. It was settled in October 2001 by the Supreme Court, so it's 8-year-old law now. Now, this has been quoted and goes back and forth, and people hear about it all the time, and it's a good case. But the thing that really gets involved in this is that the other people have done things, and I'm going to use a couple of other names. Mrs. Overs, in Overs versus the Queen, borrowed funds to purchase shares of his holding company. The case is Overs 2006, Tax Court of Canada, page 26. And Mr. Overs paid back a shareholder's loan, which would have been included in his income, and by doing what he did, coincidentally, the interest expense was made deductible. I don't even know, I don't think that anybody particularly knows whether he did this on purpose or whether it was something he fell into. That's never been told to me. But Mrs. Overs borrowed the funds to purchase shares of his holding company at their fair market value. So she wasn't giving it to her at his cost, wasn't doing a Section 75(1) rollover. And because he didn't do the 73(1) rollover, as another person did later on, that part didn't come into it. And Judge Little, and remember the name, Judge Little, turned down the CRA's claim that the tax benefit arose from this series of transactions. Taxpayer followed the Income Tax Act in repaying his loan and tendering the shares to his wife. Justice Little ruled that the transactions were not avoidance transactions, and therefore GAR did not apply. Judge Little ruled that none of the transactions could be considered abusive tax situations or abusive tax avoidance, because we have a thing called GAR, G-A-A-R, which is general avoidance rules, general anti-avoidance rules. Now then another case came up that was actually before this one, and it was Judge Bowman. And Judge Bowman ruled in favor of a family named Evans. Um, Judge Bowman ruled there were no avoidance transactions, that's under the GAR rules, in what could only be described as a super complicated and very sophisticated series of business restructurings that ended up with a former shareholder receiving cash by using specific rules in the Act, including Section 85 rollovers, 110.6, 110.6 capital gains exemptions, 112, which is Section 112, which is tax-free intercorporate dividends, 74.5, which is the attribution rules, and subsection 84, bracket 3, which is deemed dividends. So there's a whole bunch of things you can look up if you really want to. Judge Bowman assumed that this was an avoidance transaction. In other words, he assumed that the Evans family had done this to avoid income tax. And there's actually sort of nothing wrong with doing that if it's in the ordinary business kind of connotation. But he assumed that it was anti-avoidance or avoidance of transactions. He dealt with them on a one-on-one basis to decide whether the avoidance transactions were abusive. His final decision was that provisions of the Income Tax Act operated as intended, and there could not be any abuse. So Evans has won the case, and Evers won the case. Overs won the case. Now, Evans won the case, Overs won the case. Then another family called Lipson came along. And Lipson was actually pretty similar to the Overs case. And the Lipson case was 2006 TTC 148. And remember that the Overs case was 2006 TCC 26. So just like, 100 pages later, 125 pages later in the tax court rulings, amazingly, Judge Bowman, who had ruled in favor of Evans, which was a 2005 case, but the Lipson family was a 2006 case, just a little bit after the Overs case. Judge Little ruled in favor of the Overs. Judge Bowman, who had ruled in favor of the Evans, which used a whole bunch of rollovers and stuff, was not in the same opinion with Lipson. And he said that, and the details were that Mr. Lipson owned a profitable business. The Lipsons, number one, the Lipsons entered contract to buy a home in Fraser Hills in Toronto. Two, Mrs. Lipson took out a demand loan to buy shares in the family business from her husband. Three, the shares were transferred to Mrs. Lipson as a Section 73(1) rollover. Remember, in the case up here, in the Overs case, I made a point of the fact that the Overs did not use a Section 73.1 bracket 1 rollover. Lipson did use this rollover. This is a different rollover. There's lots of other rollovers. There's different rollovers than Evans used. So she used a 73.1 rollover, and what happens with the 73.1 rollover is that the shares, it doesn't matter. And four, Mr. Lipson used the funds to buy the house, okay, and five, they both took out a mortgage on the house to repay the demand loan. Well, Judge Bowman used the Section 245 GAR provisions to rule that the Lipson family was guilty of gross abuse of the tax system. Perhaps if they had a business reason for the loan or had not used the Section 73(1) tax-free rollover. See, when Overs sold his shares up above to his wife, he didn't use a rollover. He actually transferred them to his wife at their fair market value. Down here, the Lipsons transferred the shares to the wife at the cost base. In other words, didn't create a tax liability in there. And was a tax-free rollover. And perhaps if he had not used the tax-free rollover, Section 73(1), he would have found in their favor, Judge Bowman would have found in the Lipson favor, as he did with the Evans, as I said, just up above. In the Lipson case, the wife's borrowing did not put income in her hands, and it was unclear who had paid the interest, because remember, they took out the mortgage in both names. How silly. In January 2009, the Supreme Court of Canada confirmed the Lipson's case, or the Lipson's loss, but they also confirmed the other legitimate uses, as I've explained before, and as I did in part one of this, which was the case of the dentist. Now, there is, if you go to KPMG's website, you can find a really good legal case description of this from KPMG. You got to log on and so on and so on and so on, but you can do it. And that's the story there.